Hello investors, and welcome to Invest Like a Guru and to our weekly update where I'm gonna take a look a bit at the market and of course on our different strategies that we are running: weekly, monthly and quarterly momentum, and the ETF and ultimate dual momentum strategy. Now, as you might have noticed, the market is not really in our favor right now. The markets are dropping like a rock, and this is the US Nasdaq here, and we can see that it is just falling and falling. This morning actually the futures were up a bit, but now it seems like the sellers are coming in. And it is a good question when we will see some sort of a bounce, maybe the start of a new uptrend, or if this will be the beginning of a larger downtrend. As you know, we have this risk on, risk off factor that we are using, and right now our models, they are at risk on. But it can shift quickly, and we might send notice out to all of you subscribers and trial subscribers and saying, now we are risk off again, and of course you'll have to adjust your positions about that. Now, if you are interested in a free trial, I'll drop a link below here, but otherwise let's just have a look at the markets and everything that goes with it here. Now, what is really moving the market right now? Well, basically it is Powell and it is Fed. And this week on Wednesday we'll have the FOMC meeting, which is the interest rate decision meeting, and that is what have been stirring up the markets lately. Now, you might have seen it before, but there is this website called the it is cmegroup.com, but you can just Google FOMC Countdown and you can find this. I can also put a link to that below here. But in here you can see how the market is pricing the probability of different interest rate setups from the Fed in United States. And as you can see right now, the Wednesday meeting here in January, the prices in the market are saying that there is around a 94.4% chance that that Powell will announce that they are staying with the interest rate at 0, so 0 to 25 basis points here, and there is a slight chance that that it'll go up to 5.6%. That it will go up by 0.25%. Sorry for that. So it will probably on Wednesday be staying here at the 0%. The thing that is stirring up the market right now and creating some volatility and turmoil is that Powell will probably also announce some sort of tapering policy onward. And that might be that Fed is actually starting with the real tapering. Now, up until now, they have talked about tapering their purchases, meaning that they have been supporting the bond market by buying a ton of bonds. And that is quite quickly being tapered down right now. So they will hit 0 extra purchases in March. At least that's what they're saying. And then they might start to taper the actual balance sheet, meaning that they will actually start to sell out of their bonds. They did that in 2018, and that was actually what started that, you could call it crash, that downturn in the market of 20% in the Q4. We can see it in the charts here. If we scroll back to 2018, you can see we had this drop in markets here. It doesn't seem like much, but people were quite nervous, and we had a drop in Nasdaq of something like 24%. And then Fed intervened and said here in the New Year days, Christmas New Year days here of 18, they went out saying they just raised the rate here in December, and then they went out saying now we might start to cut the rates again, and as a result of that, the market went straight up here. So it has been going up a lot, as you can see, but right now we are dropping. The Nasdaq is down 14%, and if nothing else happens, Powell is announcing a tapering of the balance sheet and maybe a rate hike in March, well then we might see some more turmoil and downturn in the market. But that is pure speculation. As you know, our models are 100% complete automated algorithms, so we are not really we're not trading on behalf of what we believe will happen with the Fed or the market. But as you can see here, in the FOMC Countdown, you can see that if we scroll on to March and see what does the market price in, it prices in with an 88.2% chance that the interest rate will be hiked by 0.25%. And there is a 5.2% chance, or risk you could say, that it will be raised by at least 50 basis points. There's only a 6.6% chance that it'll stay at zero. And if we are going onwards to May, you can see that there are speculations and big chances that the interest rate will go up almost once per interest rate meeting here. So the Fed is saying at least 3 rate hikes here in 2022. It might actually be more. So that is something you can keep an eye on. It is interesting to see how these percentages change over time. Now, if we're looking at the overall interest rate picture, then, as you know, I have made this chart here where we can see all the interest rates down from 2 months and up to 30 years here. And as you can see, all of the longer term interest rates, they are dropping here. And that is simply because the investors are nervous and they're going into bonds. They're selling stocks and buying bonds. And when the price of bonds are going up, the interest yield is going down. But you can also see that the shorter term interest rates are going up, meaning that these bonds are being sold because investors are expecting Fed to start selling their bonds as well. So nobody wants to be in these bonds. So these yields are going up along with the interest hikes from Fed. So what we can see here is a narrowing of the gap between the longer term interest rates and the shorter terms. And we can also see that on the chart that I have shown in some videos here. This is what is called the dynamic yield curve. And what we should be afraid of here, or at least we should notice, is that normally we will accept the lowest interest rate on the shorter term bonds here, and then we will demand a higher yield for the longer term bonds. Now, what we are seeing right now is that this one is getting more and more leveled out. And if people are getting really, really nervous, we might actually see an inverted yield curve where people are accepting lower interest rates far out in time simply because they're buying up so many long-term bonds because they're nervous about the market. And if we're taking a look here, I know I've shown you that before, but if we're going back just in recent time, we can see that something like this happened back just before the financial crash here in 07-08. And we can see it also before the dot-com crash in 2000, 2001 and 2. So it is definitely something we should be worried, or at least we should pay attention to. So that is at least what is indicating, the charts are indicating that this spread between the longer term bonds and the shorter term bonds are narrowing down. And if they start to shift place with each other, we should be kind of nervous. So that is what is moving the market right now. I know there are trouble in Ukraine. I know there are fights with China. There's the Taiwan issue and so on and so forth. But right now, the market only sees one thing, and that is the interest rates. So let's have a look at what that is doing to our models here, because it is not a complete pretty picture right now, but that is what can be expected. And these are automated models, and we are used to taking some drawdowns. It's never fun to see your portfolio in red, but when we're looking at the weekly momentum strategy, and I should say, I am not personally trading the weekly momentum strategy because I like when I buy the stocks for a month or primarily for a quarter, I like my stocks to get a bit of breathing room. So right now, as you can see, we have a year to date on the weekly model of around 13.5%. And that is, of course, not nice. That is how it is when the market starts out with a huge drop. As you know, if you read articles about it, it is pretty much the worst start of the year in, I don't know, several decades almost. So that is what we can see right now. There's not much to say that. It is rotating the stocks every week. and it has a pretty high volatility, pretty high max drawdown, and that's where we are at right now. We are at a drawdown from around October, November time here until now at around 23%. You could say that 23%, it takes a bit to stomach, and it can be even higher, but that is the price of getting 30-40% per year sometimes with a strategy. That is the price to get higher volatility, higher max drawdowns. If you only want max drawdowns of a few percent and a very low volatility, you're simply not getting as high a performance as normally. So that is a choice you make. Now let's have a look at the monthly model here just quickly. Again, it is not showing the best of, let's see, it comes here. It has a bit better performance, 11.75%. Again, max drawdown around the 23%. And yeah, we are in a drawdown right now where I'm considering putting more money into the models. As I've told you many times, I'm not a big fan of buying single stocks when they drop 25%, but an overall portfolio with many stocks. Now, these models are only using 10 stocks, but with a decent amount of stocks and a good back test, I don't mind putting my money into a drawdown of a strategy like this. And if we get a bounce all of a sudden in the market of 5 to 10%, we'll get the same in these portfolios, and I'll get a quick return just from trying to time this drawdown. So that is the monthly model. And of course, since both the monthly and the quarterly models are going into the same stocks here by the 1st of January, then when we get to the 1st of February, these two will start to deviate a bit. But as you can see, they're pretty much the same right now as they should be. So they are having a hard time right now, but I am I'm assuming that we will see a bounce, and otherwise, yeah, we're just following the market. It gives a great calmness, even though it is annoying to see these drops in the portfolio, of course. Now, when we're looking at the ETF strategy, as you know, it is a lot more conservative. So the year to date is only minus 6.5% here. The max drawdown is only around 8% with a lot lower volatility. And as you can see, here's a good example that if you accept lower volatility, well, then you also get somewhat of a lower return overall. The ETF strategy is not doing over time as well on percentages as the stock strategies, but it is definitely running with a great Sharpe ratio over time, and that is simply because of the lower volatility. Now, the last strategy here, I'll show you the ultimate dual momentum. That is the one we have enhanced from the normal dual momentum strategy, if you've seen these videos, and that is having a year-to-date return of 10.5%, which makes sense in the current market. So there's not much to say about this market. I know it is annoying if you have just started following these strategies around New Year here, but that is how it is. It is just unfortunate that that you have started up straight into a big drawdown then. But I'm not too concerned. The models have been holding on. We have tested them way back in time, and they're holding on also through crashes like this. So that's all for today. It is a bit of time to stomach the drawdowns, and let's see what the markets do. I will be back later this week with a video about cryptocurrencies, where something exciting, or interesting at least, is happening right now, and we'll do a lot of statistics and research on that. So you can look forward to that. I'll talk to you again shortly, and take care of yourself and your money out there. Bye for now.